Okay, well, thank you. Thank you. So thank you to the organizers, Governor Marcel, Vice Governor Vial. Thank you. Thank you very much. Can you see my screen? Can I
Yes.
start?
Yes.
Yes. Okay, excellent. Good. So this is joint work with John Berger of Loyola University, Maryland, and Veronica Warnock, University of Virginia, Darden. Um, the paper is KF star, the natural level of capital flows. Um, and I'll start with the motivation. The motivation is in late 2016, someone, a prominent economist, asked us, sent an email and said, do you think that the sharp decrease in 2015, 2016 in portfolio flows to EMEs, do you think it's temporary or more likely to be permanent? And I give you on this slide the pictures, the data that were available at that time, and in both emerging Asia and Latin America, the flows had dropped pretty suddenly, and it was quite a drop. And we didn't quite know how to answer this question, whether we thought it was going to be temporary or likely to persist. And so we consulted some stars, right? So we took a step back and we thought, well, we have this problem in various other parts of macroeconomics. These graphs are all US based, sorry for being US centric, but that's the data I have available. And we have potential GDP and actual GDP, NAIRU and actual unemployment, core inflation, headline inflation, the real Fed funds rate and R star. All of these things, all of these stars are an estimated construct with definitions that are going to vary across researchers. But they're all very useful because they provide a real-time measure against which we can gauge the macro variables that we care about. And each of them are going to help us understand some aspect of the economy. For our purposes, I think potential GDP is actually really instructive. If we think about how the CBO in the US creates potential GDP, they start with a standard framework, the solo growth model, and it's a framework that focuses mainly on the supply side of the economy rather than fluctuations on the demand side. And when they implement, they note that the capital share, alpha, in the solo model is quite volatile, and so they smooth it. What we're going to do is something very similar. We're going to start with somebody else's theory, so from Thiel and Van Winkoop. It's a supply side theory, and we are going to smooth some weight, although it's not actually vital that we do so. But keep solo in mind, keep potential GDP in mind as we go through this talk. All right, so we're proposing the natural level of capital flows, KF star. It relies on the theory of Cedric Thiel and Eric Van Winkoop, where they brought portfolio choice into a DSG open economy model. In that model, if you go back to that paper in JIE, they have two types of flows: portfolio growth flows and reallocation flows. KF star is the portfolio growth flows, right? That's really, in simple terms, what it is. The flows that result when new savings, which is the supply of new funds available for capital flows, is invested in line with zero order portfolio shares. Now, these zero order portfolio shares, in theory, it's the weights that you would observe absent any shocks to expected returns and expected risk. In practice, we and also Eric Van Winkoop in a recent paper used lagged actual portfolio weights as a proxy for these zero order weights. For us, we're going to use a simple lag of the portfolio weights. We're actually going to use a lag of a 5-year moving average, but a simple lag would suffice. That's what Eric uses in his work. And in our paper, the choice of the lag, the smoothing. So if you just think back for a second to the smoothing that CBO does for alpha, the smoothing that we do for the weight doesn't affect empirical results. So the portfolio growth flows are really that's how you can think about our KF star. There are other flows, reallocation flows. So for example, I could have been excited by the news in Chile yesterday, and I'll alter my portfolio toward Chile. That would be a reallocation flow. That's fine. Those flows occur. What we're really getting at is this natural level of capital flows. Is the portfolio growth flows? It's just the new funds available, the new savings by the rest of the world, and we hit it with some weight, some actual weight. Okay. Good. To make it a little bit clearer, so this is an annual measure, KF star. It's supply side construct, current period, rest of the world savings. That's capital S, rest of the world, that we hit with a lagged portfolio weight. And again, we do a 5-year moving average, but 1 year, 2 year, 3 year, that doesn't really matter. And why does it not matter? It doesn't matter because capital flows are so volatile that it doesn't matter how much you smooth these weights. The volatility of the flows far outweigh that, and so everything I say will hold with a 5-year moving average or just a simple 1 year lag. The rest of the world weight, this omega, is just the country's equities and bonds. Or the weight on countries' equities and bonds. It's just the stock of that country's portfolio liabilities, its holdings so the rest of the world holdings of its equities and bonds divided by rest of the world weight. I said equities and bonds. Our measure is of portfolio flows. So let's be clear about that. We don't look at DI and we don't look at banking. It's portfolio flows. The data to form KF star are readily obtainable and publicly available. And so when we go to the IMF WIO data set to get the flow of private savings that we construct as national savings minus government savings. So that's how we get the rest of the world savings. So we just take global savings, private savings, and subtract off the recipient country savings, and that's rest of the world savings. Portfolio weights, we just we get the holdings from the Lane, Malesi, Freddie External Wealth of Nations data set. The wealth, so the scale factor is financial wealth, household wealth from Davies et al. Credit Suisse data on household wealth. We can create KF star for 184 countries, including many that don't have flow data. So really the limit is just, is it in the Lane, Malesi, Freddie data set? If yes, we can create KF star for that. Now, of course, when we look at how it helps us understand capital flows, and we have to bring in capital flows data, that's going to be a smaller sample size. When we have other applications, that's going to be a smaller sample size. But if we're just looking at KF star, we can create it for 184 countries. To get a sense of what drives changes in capital flows, there's only two components. It's the rest of the world weights on your bonds and equities, and it's rest of the world savings. The left graph here just shows the evolution, the change in the portfolio weight plotted against the change in the size of the markets. And so what you have here is sort of a relative I cap M. We know cap M doesn't hold all that well in international settings because of the home bias, but it is the case that the markets that grow more have a greater weight in investors' portfolios. We're not saying that there's causation here that we're willing to dive into. We're just, if you ask why or what's behind changes in the weights, it really looks like changes in market size. The right graph shows global private savings ex-China. That's another driver of KF star. So it grew very strongly through 2011, and it's been roughly flat ever since. Ex-China, and a lot of details I'm not going to be able to get to in the next 20 minutes, So I'll point you to the paper and an online appendix for a lot of the details. But briefly, the ex-China is, so we create this KF star going back to 2000. If you want to come up with a measure that goes back 20 years, and you think about China's role in global savings over that time, they were about a quarter of global savings, but had very, very small outward investment. Even if you bring in the reserve accumulation that they did, it's still small. And so what we do is we just strip out China's savings, and we have to make other adjustments for that. That is something that going forward, if you create this going forward and you don't have to worry about a long time series, you wouldn't have to do, because we do have better data now on China. But if you want to go back 20 years, then you're going to have a China adjustment. And so there's details about that in the online appendix. These graphs just show if we didn't allow the weights to change, what would KF star look like for the US, Euro area, and Latin America, Caribbean. And so that the thinner red line on each of these graphs is a fixed weight. So we just hold the weight at the 2000 levels, the portfolio weights. And the only thing that is driving the change in that thin red line then is rest of the world savings. And the thick blue line is actually our KF star measure for these areas. The gap between the two is a representation of how much the weights have changed. Latin America Caribbean graph looks different than the others because, as you can imagine, if we're using a 5-year lagged weight starting in 2000, Argentina had a very high weight. So that is, foreigners had a lot of investments in Argentina through 1999. Things changed shortly thereafter, and so that fixed weight that we hold at 2000 was actually quite high for Latin America. All right, so some applications of KF star in the paper. So we have a paper in IMF Economic Review 2018 where we showed, using annual data, that there is a long run relationship between actual portfolio flows and KF star, with the flows adjusting to the benchmark. And that KF star predicts the direction of one period ahead changes in inflows about 2/3 of the time. The current paper says, well, okay, that's all well and good with annual data and in sample, but we're going to be, in this paper, out of sample and using quarterly portfolio inflow data. And so here's the outline of the next 15 plus minutes. We'll focus on how well KF star does in out of sample medium term forecasting exercises. We'll compare it to various out of sample filtering methods and an in sample one as well. And then we'll have some other applications where we'll use KF star to predict sudden stops, equity returns, and flows during the last two major shocks. And so the question is, can we actually predict these future portfolio inflows? And I just toss up graphs for 4 countries here. You get a sense of the issue, right? These things are very volatile. At a point in time, it looks to be very difficult to predict. And sure enough, even if we try to estimate models to describe these quarterly portfolio flows, the R squareds tend to be quite low, usually around 0.1 or so. But we're going to do it, right? And so we're going to use KF star, and to preview the results, it's a strong predictor of future flows. So portfolio flows do seem to oscillate around KF star. The deviations from KF star are short-lived. And especially over the predictability is especially strong over a 4 to 8 or 5 to 8 quarter horizon. The explanatory power is pretty impressive. It's explaining about 40% of the medium run variation in portfolio flows. Performs really well against different techniques, including the in sample Hamilton 2018 linear projection technique that was explicitly designed to make predictions like this, to predict things 4 to 8 quarters out. And then we go through some applications, and it performs really, really well in those applications 2. All right, so now here's those same graphs from 2 slides ago, but now with KF star. And KF star is not a trend. Remember, it's built up from the supply side. So it's rest of the world savings that we hit with a lagged portfolio weight. This is at any one point in time, and since we'll be predicting forward, you can think of KF star as an out of sample, the predictions as being out of sample. But this is just a graph, and it's apparent from these graphs, and in the paper or in the online appendix, we give you graphs of every single country that are in our sample. So I'm not cherry picking here, but it's apparent that flows come back or oscillate around KF star, and we'll show that empirically as well. The main tests that we use are going to come from this test from Cogli. I think it was maybe JMCB 2002 or so, roughly then, when the application was to trying to come up with a measure of core inflation, right? And so Cogli recognized that central banks they're gonna want to extract the true inflation signal from the noise, and so we came up with a simple test, which basically, if you get down to the bottom equation, it just says that the H period change in inflation on the left-hand side of the bottom equation, if we regress that on a constant and the current deviation from some measure of core inflation, if that beta H is -1, that means that going forward, inflation is going to fully adjust to the current gap, right? So the current gap between actual and core, if we have a beta of -1, then we get a full adjustment H periods ahead, back towards the measure of core inflation, this pi star here. So we're going to do the same exact thing, but just port this to capital flows, and it's the same idea. If you get down to the last equation on this slide, it's going to be the current gap. So on the right-hand side, the current gap between inflows and KF star. Does that help you predict the change in flows H periods out? And the H periods out, we're going to do, so it's quarterly data, and we'll do 1 through 12. So it'll be T+1, T+2 through T+12 that we'll examine. And so the key here is whether beta is close to -1. That is the Cogli test. This next slide is for emerging markets, and on the left side we have the beta estimates, and so this is country by country. So there's let's just go with 28. I think there's roughly 28 emerging markets in these, and so we run 28 individual regressions. This forecast exercise. These are box and whisker graphs where the box is the 25th to 75th percentile of the estimates, where the mass of the estimates lie, and the horizontal line within the box is the median coefficient estimate. And so focusing first on that left side graph, and I have a line drawn where beta is -1. You see that once we get out to 7, 8 quarters out, beta is very close to -1 for many countries, right? And so it's that suggests that it is actually that KF star is actually a good predictor of flows out 6, 7, 8, 9 quarters. The R squareds are on the other side, and you see those R squareds are quite high compared to what we're used to in the capital flow literature. The typical capital flow regression would be 1 quarter ahead. So we almost always lag things on the right-hand side, and so it's always 1 quarter ahead flows that we're trying to explain. 0.15 would be considered really good for capital flow regressions. This is more like 0.4. So flows are very much reverting to KF star, and that's for emerging markets. For advanced economies, the results aren't as good, and I'll dive into that a little bit more in a few minutes. The estimates of beta are further from -1, right? They're still close to -1, but they're not nearly as close as for emerging markets. And the R squareds are a little bit lower. I still have the line drawn at 0.4, and you see that they're more like 0.3, the mass of observations. So it's still pretty good compared to an R squared of 0.15, but it's just not as tight as with the emerging markets. We then do horse races, right? So that was just KF star by itself. We then do horse races. We've got a moving average. So always in this, the thick blue line is KF star. The left graph is of beta, is the mean absolute deviation from beta equals -1. So you want that to be a small number. The right graph is the average R squared. And we have a moving at just a simple 12-quarter moving average that we run it against, and a one-sided HP filter, and the Hamilton in-sample linear projection method. If you look at the left graph first, the KF star performs quite well, especially once we get out to the medium term. It's as good as Hamilton, and remember that Hamilton is in sample using all the data for the entire time series, whereas KF star is an out of sample predictor. So that's pretty good. And on the right side with the R squared, it also performs well. So for emerging markets, it seems to be a very strong predictor, and it does well against reasonable alternatives. For advanced economies, as I said, it's not quite as good. It's still fine, but it's definitely not as good. And when we look at what's behind the, let's say, relative underperformance for KF star for advanced economies, we think it's probably about reserve accumulation, which was really strong. Global reserve accumulation really strong through the first half of 2014. And that increased the weights on some recipients, such as the US, Euro area, and the UK. And since the reserve accumulation has pretty much ceased, and so we have lower inflows for some of those recipient countries, and that seems to be what's driving. If you look at which countries are behind the relative underperformance, it's which advanced economies, it's US, Euro area, UK, and Iceland. All right. So what's the takeaway that we have so far? KF star performs well, better for EMEs than AEs, that's for sure. Some filtering techniques perform well too. And so our takeaway is that there is a natural level of capital flows, and there are various reasonable proxies. We like KF star. We think that it being theory-based, we can understand deviations from it a little better than filters. Than if we use filters. And here's one example, and we have a few examples in the paper, but here's one of Chile. So the left graph stops in 2015 Q2, and it has a 12-quarter moving average, the Hamilton method, and KF star, with KF star being the smoothest line. What you see is that in 2015, you would say, if you're looking at the filtering methods, you'd say, yeah, flows are oscillating around some normal level. They seem pretty normal. They're volatile, but they're oscillating around. But if you look at KF star, it would have said back then that flows had been abnormally high, and that you'd expect them to come down, actually. And then sure enough, if you look at the right graph, if you roll it forward, they did come down. They then bounced up towards the end of 2019. I'll talk more about that in a second. But having a theory-based benchmark, we think is very helpful, and we have other examples in the paper too. All right, good. So that's so I've gotten through just laying out KF star and its forecasting ability, its comparison with various out of sample and in sample filtering methods, and now we're going to get to some applications, some other applications. So the first one is to use the gap between actual flows and KF star, which I'll call the KF star gap. Use it to predict sudden stops. And here we just take the work that I've done with Kristen Forbes on sudden stops and surges, and we just add the KF star gap, the gap between actual and capital and actual flows and KF star. And we try to predict out further. With Kristen, we've always predicted out 1 quarter. And so here, because KF star is more of a medium-term predictor, we're going to predict out 6 quarters. All the results hold for 4 quarters ahead through 8 quarters ahead. Just use exactly the same variables that Kristen and I use, and we add the KF star gap. You don't have to be able to read any of the numbers on this. I purposely made them small. No, I didn't. But even if and so the takeaway is, even if we control for everything that Kristen and I controlled for, this KF star gap really helps predict sudden stops going out 6 quarters. Not so much for surge, I mean, not at all for surges. So it doesn't help us predict surges. One way to interpret this is that stops are preceded by periods of booming flows, but surges don't necessarily arise from periods of depressed flows. If we think about actual flows in KF star and global growth, so global growth is one of the drivers of KF star. So if we have strong global growth, we're going to have strong global savings, and KF star is going to be increasing. If we have global growth, just one standard deviation above its mean, so I'm not talking about screaming global growth, one standard deviation, and then global savings will tend to be increasing. So KF star is increasing. In that situation, if actual flows are growing even faster, so we have a KF star gap of one standard deviation above its mean, then we have a 31% chance of a sudden stop in 6 quarters. So strong global growth coupled with flows increasing even more than KF star, that's when we have a pretty high probability of a sudden stop. This is similar to the gap analysis that BIS has for credit to GDP, so their credit gaps or the debt service ratio. It's a very similar thing going on. With the BIS data, when things are growing much faster than trend, that then predicts a banking crisis. We have a similar gap analysis going on when KF star is growing and actual flows are growing even faster. A sudden stop is likely in 6 quarters. So it's a very, very similar type of process. We also use KF star to predict next year's equity returns. And so we control for a bunch of standard factors here. And the impact of the KF star gap is still quantitatively significant. And it's a similar story. So if we have strong global growth and we have flows above KF star, that predicts future trouble. And these results are pretty big. If we're one standard deviation above on both those things, we get on average, a 10 percentage point decline in equity returns the next year, which is a pretty big number. The last application is during crises. So if we stop the clock before the GFC, or if we stop the clock before the pandemic, did KF star, the gap, actually help us predict the magnitude of inflows during the crisis? On the left graph, it shows us, yes, absolutely. It's a pretty tight relationship. So those countries that had a more positive KF star gap prior to the global financial crisis, their flows fell the most during the crisis. At the eve of the pandemic, we wrote that most of the KF star gaps are actually negative, not positive. And so there wasn't a huge scope for countries to really, for flows to really fall a lot. And this is very different than prior to the GFC. There were a couple countries, including Chile, that was having a positive KF star gap prior to the pandemic shock. But overall, we'd say the flows, the drop in flows during the pandemic shock should be relatively short-lived. And sure enough, if you look at the right graph here, there is a relationship. So one, the drop in flows were nowhere near as large during the GFC. And it's still the case that those countries with a higher KF star gap going into the pandemic have a larger drop in flows. So the final slide to summarize, KF star does appear to represent a natural level of flows, and it performs quite well in predicting flows over the medium run. It predicts sudden stops and equity returns, and it helped us understand flows going into the GFC and the pandemic. And I would say, if you think about the components of KF star, it means that if we're thinking about long run outlook for flows, it depends on